Welcome to Investors Insights, where today's topic is Fed Fury. A lot going on this week, corporate earnings, but the big news is going to be on Wednesday around the Fed. Trey, talk about that. There's a lot going on.
Yeah, thanks, Bobby. So for the last few years, really, the market has been 100% focused on what the Federal Reserve is going to do. Now, during COVID, it was very stimulative, but in 2022, that flipped to being very restrictive, where the Federal Reserve is trying to get the market and prices to drop. And so going into 2023, the story is the same. So what we're watching this year is, when will the Fed feel comfortable with pivoting from a restrictive hiking to maybe either pausing or turning around? So this week's meeting is very important. It'll be the first meeting of 2023. They'll announce on Wednesday what their rate policy is. Expectations are to go from 4.5, where Fed funds rate is now, up just 25 basis points to 4.75. That's a big move, considering we had 75 basis point hikes many times through last year. So this is a little bit more accommodative. But you can see in this chart, we've talked about this throughout the years, is that the Fed will not stop hiking their Fed funds rate until it is above CPI. History is a really good guide of this, and that's where the Fed thinks they've finally beaten inflation. The Fed funds currently at 4.5 is likely going to 4.75, but inflation most recently was at 6.5. So still a lot of work to do. The good news is between this meeting and the next Federal Reserve meeting, which will be March 23rd, there are 2 inflation prints. So the Fed's guidance on how they view the potential inflation between now and they meet next is going to be very huge, because by the time they meet next, hopefully inflation has come down to a point where the Fed can at least pause. And you can see why the market think that a pause is so good. This chart that I'll show you shows, if you look back historically, the Fed doesn't sit idle very long. As soon as they get to that peak level, they usually have made some sort of mistake, some policy mistake, where they chase inflation up. Similarly, they then chase the market and the economy down on the other side, because they typically have overhyped. And so they have to immediately start cutting rates. Now, cutting rates is very stimulative for the stock market, and that may put a low end, and we may start seeing what could be a sustainable rally, which we haven't had in many, many months. So that's why this decision is so important. It's not really what they do. We all pretty much know what they're going to do. It's what they say, because there's so much teetering on when they can pause and then likely reverse course, which will help the market.
Yeah, thanks, Trey. So the Fed funds rate, Ty, talk about that. We might see the first positive real rates for the first time in a while. Talk about that.
I guess I'll just kind of start with the inflation. So we got core PCE last week up 0.3%, 4.4% year over year. I know that's different than the CPI number Trey just highlighted, but core PCE is personal consumer expenditures. Kind of focuses more on business, and it's a key reading part of the CPI. So with that being said, over the past 3 months, core PCE is only at 2.9%. Well, the Fed funds rate, as Trey just alluded to, is at 4.5, possibly going up to 4.75. We're looking at the first time in a long time where we might have some real positive rates. I mean, it was just a few years ago we were talking about negative nominal rates, not even including inflation, and now we're looking at positive real rates, which would be the Fed funds rate minus inflation. So that's very interesting, and it gives you a lot of different options out there. As opposed to the negative interest rate environment that we had for quite some time.
Yeah, and as we head into another big week of corporate earnings reports, one of the big stories so far this earnings season is the layoffs being announced by some of the big technology firms. And some might think that the Federal Reserve will be happy with the layoff announcement. But looking deeper into the situation here, the headlines might be a little misleading. So looking at this chart of recent layoffs announced by technology firms, it gives a better picture of what's really going on. And as you can see in the blue lines, they represent the percentage growth in workforce during the pandemic, and the orange lines on the left represent recent layoffs. Look at Amazon. They increased employees by 93%. Spotify increased 122%. Some of these companies had record hiring sprees, so the recent layoff announcements seen in the orange lines are not too surprising. And looking at Meta, it increased its workforce by 94%. They just announced layoffs of over 12% of the workforce. Not a big deal, considering that the size of the recent hiring in the recent years. Also, we're hearing that those in technology losing their jobs are being rehired fairly quickly, even some days later. So if we hear more of layoffs this week from technology companies, it might not be as negative for the stocks and future guidance as some might think. As always, it's important to look at the full picture. So a lot going on this week, corporate earnings, big decision by the Fed. It's not boring. If you have any questions about everything we discussed, please reach out to us. Thanks for watching. We'll see you next week. Thanks.